You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koós, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Happy Election Day, everybody. I think probably the better way of saying it is it's almost over, right? For most of us anyway. I'm recording this midday, which is normally not usual for the podcast. Normally we schedule this weekly on Thursdays or Fridays each week. But because we have Election Day, I purposely put off last week's podcast until today so that we could go over all kinds of fun stuff having to do with the election, the stock market, looking at what's going on today, as well as maybe some probabilities and possibilities of things that could happen here in the days, weeks, and months ahead. So before I get into that, of course, I've got my housekeeping items as usual. Thank you so much for listening. The podcast is recorded weekly, and as stated in the intro, CASH stands for Creating Affluence, Success, and Happiness, and that's our goal. Every single week, our goal is to make you more successful, happier, and educated than you were when you began listening today. So please feel free to subscribe on iTunes and YouTube. We're on both. In addition, you can feel free to follow me on Twitter at Adam Koós, as well as on Instagram at Financial Surgeon. Our Facebook page is facebook.com/Libertas Wealth. And then if you want to sign up to get these updates, as well as all our other articles, videos, and updates on the stock market and so on, educational articles, feel free to go to our website and you can sign up and have all these updates sent directly to your inbox. Last but not least, as always, all these visuals that I'm going to be showing you today are available on our website at libertaswealth.com in the education section, and we'll be posting them under podcasts. And as always, I'll do my best to number them for those of you who are listening on iTunes. And this is going to be a tough one today for those of you who are listening, because I'm going to be talking about a lot of charts. Obviously, it's a very visual episode, so I'll do my best to talk my way through it here. So let's go ahead and jump ahead. First of all, I always like to start with quotes. I've got a few today that are all applicable. Brian McKnight, one of my favorite singers, favorite artists of all time, he said, "I just want people to take a step back, take a deep breath, and actually look at something with a different perspective." And I think that goes for both sides of the aisle. I think that we all probably just need to take a step back, regardless of who we want to win this election, and just take a deep breath and just look at different perspectives and realize that whoever wins today, and whatever side you're on, it's not going to be the end of the world regardless. The next quote here is a great one, I think, and I again, regardless of who wins, the quote goes, "New beginnings are often disguised as painful endings." So again, no matter who wins today, or tonight, I guess I should say, I think many times, it's not going to be the end of the world, but many new beginnings, regardless of what they might be, are disguised as painful endings, regardless of who wins. And the last one here is Colin Powell. He said, "Always focus on the windshield and not the rearview mirror." So I think it's really important, again, to always look at what's in front of us, because we can't change the past. We can't do anything about what happened yesterday, last week, last month. All we can do is focus on what we're doing right now. And I think that pertains to life in general, and I think it also pertains, of course, to our money, our retirement planning, financial planning, estate planning, and investment management. And obviously that's what we're going to focus on today. So let's dive ahead into some of the charts. So I've been posting on LinkedIn, on Twitter, Facebook, Instagram, as well as in these podcasts and our videos and articles, this study that was done by Ryan Dietrich, a friend of mine at LPL Financial. He's the head of technical analysis there. And going back to 1928, as you can see, if you're watching, for those of you who are listening, going back to 1928, of the 23 elections that have taken place, when the stock market is up, the S&P 500 is up in the 3 months before Election Day. So if on Election Day, the stock market's up for the 3 trailing months beforehand, in 87% of those cases, in other words, 20 out of 23 cases were elections, then the incumbent won. Now, the other 3 times, it didn't work. The statistic didn't work. So what I've been watching this entire time, not to say that this statistic's going to work this time, because of course it could be one of the 13% of times it doesn't work, right? But what I've been paying attention to and tracking every single week, and in some cases more than once a week, is this election tracker. So let's take a look at that. So again, just to recap before I move on to the chart, if the market is up in the 3 months prior to Election Day, on the close of Election Day, which is today, then typically the incumbent party wins. Doesn't matter if it's a Republican or a Democrat. And obviously, if it's down, then the challenger typically has won. So here was the yesterday's close. So when we look at the market close yesterday, again, the stock market was up through most of August, started coming down through the beginning of September, and started tipping toward the higher probability of Biden winning. Then it started cutting back up again at the end of September into October, then headed back down, and it started to look like we were going to have kind of a photo finish today. But today and yesterday, the market's actually been doing well, which is kind of strange. It's not been the highest volume in the world, which means I wouldn't say there's a ton of conviction behind the movement, but the bottom line is that the market was up yesterday, and it's up again today. So what I did was I actually updated the chart intraday today to give you an even closer look at what's going on. And this is, I believe, here I put it down here, 11:32 a.m. So as of 11:32 a.m., I use the S&P 500 ETF, the SPY, the SPY. The market is up pretty handedly at this point if you look back at that trailing 3 months. Now, it's going to be really interesting, I think, to find out whether or not this statistic is going to be wrong for the fourth time ever, or if this is going to be an accurate indication that because the market is up on Election Day and the 3 months trailing up to Election Day, that we're going to see the incumbent party win re-election. So pay attention to that, and pay attention to what it does throughout the day. If you want to pull up the S&P 500 ETF, you can do that yourself. Just go to stockcharts.com, Yahoo Finance, or whatever your favorite charting website is. CNN, you can do it. I'm sorry, CNN. CNBC, you can do it there. And look at that 328, 329 range. That would be the line in the sand, or the line of determination, I think, below which this could change quickly. Although, if I'm being honest, I don't know that I see I don't know, anything could happen. I mean, we've got 4 hours left in the trading day here today, but I don't know that we're going to see the market fall that quickly, especially as strong as it started today. But we'll have to see, again, more importantly, whether or not this ends up indicating an accurate probability of the incumbent win or not. So we'll see what happens here. Moving on to some more broad market commentary. I've been saving this since the weekend because we had the month of October close out, which means we get to look at our monthly charts and see how they look. So with these candlesticks here, each one of the candlesticks that you're looking at is 1 month. And you can see here, this is 2018, and then the correction we had there, then at the end of 2018, we had another correction down about 20%, and then we had the Corona crash earlier this year, huge drop of well over 30%, 35%, and then we're sitting right here where the market's kind of broken out to all-time highs recently. And now we've seen two black candlesticks, or heavy. Think of the black candlesticks as heavy down days, whereas the white candlesticks are hollow. They're not technically white. Consider them hollow up days, or up months in this case. And what's concerning me long term, and today I'm purposely doing this long term to short term. So what's concerning me long term is that because if you're on iTunes and you're listening, you can't see this chart obviously, but the monthly chart's been generally speaking printing higher highs for the last 2.5 years. However, momentum, as indicated by relative strength index in the bottom pane here, for those of you watching on YouTube, is printing lower highs. We want to see momentum break northward to confirm the higher prices that we're seeing, or higher market movement that we're seeing this past few years. And I've been watching this for quite a while now, and it's just concerning to kind of see it continuing to weaken every time we hit a new high. So hopefully we can see this negative divergence of lower highs or weakening momentum relative to the higher highs in price start to work its way out in the next few months into 2021. That's my hope. So we can see things go up, not down, obviously, from here. The next thing I want to show you, switching to a weekly chart. So this is another kind of point of concern that I have. So that every candlestick on this chart's a week now. We're not talking about months anymore. So every candlestick's a week. Again, they got the Corona crash right here. But what I want really to pay attention to is two things. One, how the market sliced through its 10-week moving average here. Now, as of today, and the market's not closed today yet, and on a weekly chart, we would have to wait for the market to close at the end of the week. But if the market were to pull back above its 10-week moving average, that would be a positive thing. But for now, it's sliced through its 10-week moving average. And the other thing I'm looking at is what's called a MACD, or moving average convergence divergence crossover, a negative crossover, pretty close to above 100 here. So we had the same thing happen back before the Corona crash. So back in February, just before the market tanked. And what we're seeing is that same thing happen now from a high level. And after it tried to cross forward here, or cross below it in September, October, and failed, and now it's crossed below its signal line. So that's kind of concerning. When I compare that actually to 2018, 2019, you can say a similar thing happened. So we had a negative crossover here in early 2018, but the market just kind of traded sideways, went up, then headed back down again about 8%, and then it kind of was off to the races, regardless of a lower MACD line. And then you see here in 2018, toward the end of the year, before we had that 20% drop from September through Christmas Eve of 2018, we had that negative crossover here as well down in the lower pane. So in other words, momentum and different indicators are suggesting that right now the risk-reward relationship of the market is a little iffy, and just looking at what I've shown you so far, it's a reason why we would want to be a little bit concerned, maybe be a little cautious. All right, let's move on. This is looking at a weekly chart, and what I want to point out here on this chart is that for those of you listening, is back in the Corona crash when it started back in late February, early March, we had this huge dark candlestick that sliced right through the 10-week moving average. So the market basically dropped quick below its 10-week moving average, and then obviously bottomed, and then we had the fastest market crash in U.S. history, followed by the fastest recovery in U.S. history. And then what we have just recently, so earlier this year, or this just a couple months ago, we had this drop in September where we kind of, limped below the 10-week moving average, but it just headed right back up again in October. But this time, again, we kind of have last week this big, dark, heavy candlestick that sliced through the 10-week again, which is, indicating that caution should be warranted. Now, of course, we have an election today, so a lot of that could be due to the election, right? A lot of the selling and the worry and the anxiety. But another thing I want to point out is that momentum on a weekly basis. So remember earlier I said that momentum on a monthly basis has been diverging negatively against price. Well, we're seeing the same thing on a weekly basis. If you can see here, on a weekly basis, momentum's also diverging negatively. And in fact, when we said hit the all-time highs in early September, late August, we actually had a lower high in momentum on a weekly basis. So that's a point of, again, a point of concern, a hint that things aren't necessarily all green. Put your pedal to the metal and floor it going forward. So I think we have to exercise caution here. Next, moving on here, I wanted to show you some other things about the bond market. This has been really tough. The bond market's been dirt. I mean, it's been really, really difficult with the exception of the very, very ridiculously low interest rates in the bond market, which nobody wants anyway. The bond market just is not good. This is junk bonds, so this is high yield bonds. Just kind of, correlates pretty highly with stocks for the most part, but you can see how it's pretty much gone sideways for 6 months, just hasn't done anything, and now it's under its 50-week moving averages of yesterday's close or Monday's close. If we look at that was junk bonds. If we look at the aggregate bond index, so this is just a big, huge basket of all kinds of corporate bonds and so on. We got bonds being underwater pretty much since this summer. So we had bonds trying to creep northward here since the crash, and then peaked. And then all of a sudden, we've just got this steady decline that's occurred since summer, which is just really ugly and not, especially when you consider the market's been struggling this past couple of weeks. You expect bonds to do better, but they haven't, which is actually positive evidence for the stock market, believe it or not. So one more chart here. This is Treasury bonds. So this is U.S. Treasuries, 20-year Treasuries. So think longer-term Treasuries, intermediate term and long-term Treasuries. Again, similar picture here. We've got bonds below water. and things just not looking all that rosy in the bond markets. Things, they don't look as safe, which again, I can't reiterate more. Typically when we see bonds doing poorly, when the stock market's doing poorly, it's an indication that the stock market's just kind of taking a pause, whereas when bonds start to show support when the stock market's going down, then that usually shows that people are rushing for the gates, whereas that's just not what we're seeing right now. So I think that this is actually saying something positive to the stock market versus something negative. So I've never shown anybody this before, outside my very close circle, but this is something that I put together this past year. I call it my pre-flight checklist, and it's a combination. I've purposely blurred out all my indicators, but it's a really amazing one snapshot of all kinds of indicators that I look at to determine whether or not you can see here, is it safe for new entries. In the middle of your screen here, and on the right you can see the true false conditions that I've created. I got the idea actually from my friend David Keller, who calls his pre-flight checklist too, so I don't know if I have to send him a check in the mail now because I've stolen its name. But and then David Cox as well. David Cox kind of powwowed with me and gave me a bunch of ideas on some different indicators that he uses as well, so appreciate both of their help, and I just want to give them a shout out here. So but anyway, these are a bunch of indicators that I've put together over time, and it's just a nice snapshot of saying, what's the market climate look like right now. And what we want to see is, we want to see more blue than red up here in the upper right. Is it safe for new entries? We want to see mostly blue, or at least half of these to be blue in the right here. So that's not what we're seeing right now, so we just have to, we have to be careful. Something else that I thought was really interesting, I vividly remember election day 4 years ago, and I remember the market going down pretty much from summer until the Friday before election day. And as you can see here, this is election day 2016, and the market bottomed the Friday before election day. So for those of you listening on iTunes that can't see the chart, the market bottomed the Friday before Election Day, and then it went up on Monday, up on Tuesday, and then on Election Day, Tuesday, overnight in the futures market, the market tanked. The Dow went down like 1,000 points. If I remember correctly, it was sometime between 9 and midnight or something like that. And then all of a sudden it started rebounding overnight into the morning, and then we had this huge, big candlestick, positive candlestick, slicing back above water here, above a 50-day moving average, and then we were just off to the races from that point on, and it was safe to start getting really offensive, we'll call it. And I'm wondering if we're going to see the same thing now, because here's the Friday before Election Day. Now, it didn't bottom. Obviously, we had a lower low back in September, but we did have a low this past week, this circle that you're looking at here. So this past Friday was the market bottomed, and then on Monday it went up. Today it's up so far, and we're just going to have to see what happens. In addition, I want to point out that momentum has never gotten below 30 and barely got below 40. So momentum, when you're looking at relative strength index, is also indicating that it's still in a bullish regime, or still in a bullish area, which is where we want it to stay. We don't want momentum to get below 40 or below 30, worse yet. We really want it to kind of stay between 30, 40-ish, and 100, and which would indicate, again, a continuing bullish market. So next thing I want to point out, this is like daily MACD. So like I told you earlier, we were going to go from monthly to weekly to daily. Now we're looking at daily charts. This is the January 1st. This black line in the sand here goes to January 1st, which I would call that a potential floor below our feet, or a floor of support. So far, the market held that support in September, and it bounced. We had a lower high in end of September, and then the market headed back down again, and now we're kind of sitting here. We've got, again, a good market yesterday, a positive day so far today, and the question is the market going to head higher from here, or is it going to break below that floor of support? But I do think that that's an important line in the sand to pay attention to, and then it'll be interesting to see if, again, MACD, this is moving average convergence divergence, this is Gerald Appel, I believe it is, his indicator. So it'll be interesting to see if we can hold and get back above zero, the zero line on MACD, and then if we can see the market head back off to the races. But I think this would be, again, a really important line in the sand here at the January 1st year-to-date number. So one of the things that somebody asked me earlier today, a client reached out and said, hey, what are you looking at? Why are you getting defensive, or why do you feel defensive? And one of the biggest reasons that I started feeling defensive is just simply seeing a lot of distribution. And when I say distribution, what I mean is the smart money selling. And when I say smart money selling, what I mean by that is that institution, the big money runs the market. The bond market's even bigger than the stock market. But when we're talking about the stock market, what we want to see is when the market's going up, so on up days, which are the black outline days here, the empty candlesticks we'll call it, we want to see big volume, because when the market's going up, we want to see lots of people participating on those days, and we want to see lots of shares trading hands and lots of buying pressure. What we don't want to see is when the market's down, lots of volume, obviously, and lots of selling pressure. So one of the things that started getting me really defensive was this past week, we started seeing a lot of red days, and then on those red days, we saw high volume. When what we want to see, if we want to see the market doing well, if we expect positive prices, positive trends, we want to see when the market's up, we want to see big up days. So big volume up days, low volume down days. But what we started to see this past couple weeks was high volume down days and low volume up days, which is obviously not good. Just to show you a couple more examples here, in late August, early September, we had some big red down days you can see down here in the bottom. So in other words, volume was much higher than the day before, and it was down. And then the same thing happened in mid-September. Then we started seeing it again at the end of October. And more importantly, if you go back in time to before the Corona crash, there was nothing but red days. Lots and lots of red days, meaning, the market's down, and it's down big on high volume, and that's what we want to start. It's almost like a clue or a sign that maybe people are trying to get out of the market. So that's what I mean by that. And then on top of that, we want the market to stay above water, or for me, that's the 10-week moving average, or in other words, the 50-day moving average. And this is the market's, the stock market, obviously yesterday. So yesterday's close, I did update the chart here today at around 11:30 noon-ish, and you can see here that the market is trying to get back above water today. It's going to be obviously interesting to see what happens when the market closes today, what happens overnight in the futures market, as we find out who is going to be the next president of the United States. And then tomorrow morning and tomorrow during the day, I think will be very telling, because it's not so much about the news, it's about how the market reacts to the news. So whoever's president, I don't want to say I don't care who the president is, of course I care, but as it pertains to investing in money and how we manage our clients' portfolios, I care more about how the market is going to react to who the next president is than I do with just the actual news that we have a new president or we have the same president. I care much more about what the market says or how it feels, and whether the market goes up on big volume or down on big volume, and vice versa. So I hope that makes sense. The last thing I'll show you today is that election years, this is again Ryan Dietrich, election years tend to end on a high note. So this has nothing to do with who the president is, doesn't have anything to do with who's in the House, who's in the Senate, doesn't make any bit of difference. Bottom line, November, December tend to be really good months for the stock market if you go all the way back from 1950 to 2019. So I think that that's some good news we can hang our hats on here as we close out for the day. So just a couple more things I'd like to share. The concerns, if we think of our post-election game plan when it comes to our retirement planning and our money, the concerns, of course, are COVID, right? Coronavirus cases, hospitalizations, they are increasing, and the hospitalizations and deaths are, of course, the thing we want to focus on, not just the cases, because obviously the more testing they do, the more cases there can be. People get tested twice, that counts as another case. So we want to focus on hospitalizations and the death rate, but they are increasing, and economic lockdowns. Now, I hold the belief, and maybe I'm wrong, I hold the belief that the United States will not shut down their economy again. I think it would be a horrible idea to do so. That's my opinion, and I don't think they'll do it. However, we're starting to see countries overseas like England, France, Italy, and other parts of Europe starting to shut down, and I haven't confirmed it, but somebody was just telling me yesterday that Chicago and areas of Chicago are looking to shut down as well. I don't know if that's true or not, so don't hold me to it. Third here, we got, obviously today's the U.S. presidential election. Both the elected president as well as Congress, the Senate are all up for grabs, but we'll have our answer, obviously, in the not too distant future. For those people who feel that we're not going to know who our president is for the next few weeks, I disagree. I don't know of a time in history where we had more votes in before Election Day than we do today. So I think that we'll probably be in better shape to know who our president is today than we would at any other time in history. Again, just my opinion. Sentiment, I think investors have been surprisingly optimistic coming into this election given the circumstances of everything that's going on with the pandemic, previous economic lockdown, increasing COVID cases. So I expected a little bit more bearishness, a little bit more fear than we've seen. So that's going to be interesting to see how that plays out over the next couple weeks. And then civil unrest, of course. Many are worried about riots and violence in the wake of whoever ends up winning this election. I obviously hope that does not happen. If it does, hopefully it's very short-lived and people just blow off some steam and get it off their chests and then move on with their lives. But again, I don't know that it's the end of the world regardless of who wins this election tomorrow. So that's kind of the concerns, I guess, the fears. But what you should be focused on instead, and what I'm focused on instead of all those concerns is the market in an uptrend? Is it in a downtrend? Or is it in a flat trend or trendless? Volume, is it bigger on up days or down days? Momentum, is it in a bullish regime or a bearish regime? Are we seeing divergences or not? Are we seeing bullish divergences? Obviously, that's good. So breadth, when the market's going up, are we seeing more participation from the smaller companies and mid-cap companies? And we have been seeing that. We've been seeing participation across the market, which is, again, a good long-term sign, which leads me to my last thing we should focus on here, which is the long term. We need to be focused on the long term. We need to not let the short term worry us too much. And if it does start to worry you, probably the best advice I can give you is turn off your computer. Don't log into your accounts. Don't look at the stock market. And that doesn't matter whether you're a client of ours or somebody doing the Robinhood thing, trading on your own. So sometimes the best thing to do is nothing. Just enjoy time with your family. Turn off the election news and just enjoy life and be happy to be alive and happy to be sharing this time with our loved ones going into another beautiful fall. So that's all I've got today. Hope that was valuable. I hope you guys learned something. You can reach out to us on Facebook at Libertas Wealth. So facebook.com/Libertas Wealth. You can come to our website at libertaswealth.com. Again, like I said, sign up for our newsletters, for our market commentary, videos that we put out, podcasts, and so on. You can follow me on Twitter at Adam Koós or our company at Libertas WM. You can also follow me on Instagram at Financial Surgeon. But that's it for today's show. Please feel free to also share this episode with your friends and family. And if you'd like to discuss your personal situation further, please remember that you never ever have to be a client to ask a question. If you'd like to set up an introduction call or Zoom meeting, head over to our website at libertaswealth.com and you can get access to our calendar there. And as I always say, there's thousands and thousands of podcasts out there, and you chose to give ours a listen today. So thank you so much for tuning in. Be sure to subscribe on iTunes and YouTube. And thank you so much once again for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koós. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.